have claims that are still open that are over 25 years old because we just can't. They don't get to a place for workers' compensation claims. Many times, it takes the lifetime of the employee for the claim to close.
Right.
So sometimes they will be open for a long time.
Exactly. So let's see. Then if you guys go to page, the page that has the premium amounts on it. So it's back to page 144. So we have these, there's 3 different options on here. And so last time we talked about, you know, how could we actually save money? Now I put together a little spreadsheet. I emailed you one, Chris. Do you need one? Want a hard copy? And Erica, I sent you one too. I emailed it to you, so since you're not here, if you're still there. So on this sheet, it pretty much. Now see, now John doesn't have one, so maybe you could forward it to him. Somebody.
I'm sending it to him now.
Oh, good, perfect. So what I've done here is I've taken the data that we've received in our packet, and I put together if over the last, we have here 8 or 9 years, we picked these programs, right? So I just took the last years and applied what we did with the JPIA and how much it'll cost. So the premium program is $1,997,000. Then we've got the $150,000 program. The premium amount is the $1,017,000. The $150,000 incurred costs are from the table that they gave us are all the costs over $150,000. And so the total, if we took that plan over the last 8 years, there's the premium amount. See that? So it would be the premium plus the incurred costs. Are you tracking with me on the top of these columns? Okay. The savings of taking the $150,000 plan versus the primary program, you know, all-inclusive plan, is in that next column. Savings cost with $150K plan. Then I added in, because I want to save a lot of money, right? Because Chris has a lot of cuts to do. $250,000 program. So there's our premium, $817,000. The incurred costs, that's everything in the $250,000 and above that we've paid. Add those together for our total costs for the last 8 years, 9 years. And there's our savings column. So the negative is how much we've saved. The positive numbers are how much we paid out that year. And on the very last column, you can see if we pick the $150,000 program, we're going to save $763,000. If we pick the $250,000 program, then we're going to have $962,000 of savings. That's over the 9 years. There's a graph at the bottom that shows. And I based this off of page 146, and I put that at the top of our agenda packet, that data. So, plus with the fact that we're adding a risk management program on top of it is pretty good. I mean, I would say that we should take the $250,000 plan, and we're going to still save what we've been paying. And the reason that we have 9 years showing here is because there are good years and bad years. Because you can see the years that we would pay out. But there's the total cost. That's if we had this over the last 9 years.
John, have you received your copy of this spreadsheet?
I have. I'm trying to follow the column and the 250K incurred costs of all below 250
It actually should say above, but.
for 18-19. Okay, I see where that comes from. Yeah, 18-19 is a very, very fresh year, so it's we would not in our exhibit. You'll see that it's not included in the gray area because it's too green. Quote. Well, I certainly understand what you're saying, and I certainly can appreciate the perspective. And really, it is your choice, obviously, but it is a choice that's being made. One other comment I would make before we leave your spreadsheet is that I would not commit that over the last 9 years your contribution would have remained at 1.99, whatever it is, 7. It likely would have been lower earlier on, and there may have been years.
Absolutely.
Maybe
I just use this as.
but you certainly needed something to work with.
Right.
So, yeah, I'm very comfortable with any of the retentions that you choose. Our suggestion was, based on our experience with particularly new members, that the primary program is a good place because you know what it's going to cost you. The fact that we're splitting it in half over the installments over the year might help some, but your choices any of your choices are welcome to us. So I would leave it at that. I just the last comment I would make is that the primary program, particularly with police and fire, with public safety, those tend to be more volatile types of exposures, and so from one year to the next they can swing wildly. Within the primary program, there's less volatility likely. But again, it's any of them work fine for us. They basically cost out about the same for us, but truly it's up to you what you're more comfortable with.
Now, I believe Councilmember Krupa asked last time, but each year we can change, right? Like if we decide next year we want to do the premium, then we can change. Like whatever we need to decide, however earlier.
If you'd like to change to the primary program from the excess program, we can certainly do that. We try not to have you bouncing around back and forth, but
right. But once we get for a feel for your program, your risk management implementations, and see a trend, then we would be able to adjust accordingly.
Yes.
We have seen a little trend since we hired Chris Lopez. Not as city manager, but when he first started. No, I'm serious. Did you see them going down? I actually noticed that and looked up the date in the minutes, because you used to do that kind of stuff when you were just the assistant, or I'm sorry, but I looked it up in the minutes.
Not a cause and effect, but
you work on it.
They're heading in the right
Take it when you can, Chris.
Chris, if you can take credit for it, because if it doesn't work, you're going to get blamed. You might as well take credit when you can. Okay.
Yes, John, this is Linda Krupa. Just to follow up on what Carly said, because I think she did an excellent spreadsheet. Why didn't you get it to me 3 hours ago? so anyway, there we go.
There we are, last minute.
Yep.
Gotcha.
When on the page with the frequency and severity, how much does that play into the premium that we would pay if we went with the different retentions? I mean, I'm looking at it, and if you take everything combined, most of our losses, the frequency in the years is in the lower amounts, but also in the severity, it's in the lower amounts. So how does that play into the retention factor premium? Am I making sense? I'm talking.
I think so. In both programs, the primary program, it is a pooled program. Everyone has a share. Basically, we start with the overall program's expected cost is X. It's the size of the pie. And from there, we slice up the pie based on your experience and your exposure in comparison to everyone else. So it's sort of from the bigger number down to the individual member agency. So that's for the primary program. The excess programs, all three of these retention programs, are based on more industry data and our internal data that drives, this is what the average member will pay. If a member's experience is better than the average of the pool and the data set, if it's better, then you'll pay less than the average. So frequency doesn't play much into it. It's really more about the severity of the losses compared to the average of the data set. And as you go up from, and this is actuarially driven, we have discounts based on the level of retention that you select. So the amount of contribution that you pay for the $150,000 retention is less of a discount than if you take the $250,000 retention. The problem in this situation is that you have enough large losses getting between the 150 and 250 that it drives your average cost of coverage over the last 5 years to kick that number higher. If you didn't have those larger losses in your history, taking the higher retentions would likely result in less cost of risk. But in your situation, because you had a few big ones, if you will, it's sort of skewing the data a little bit. And it's sort of, some of that skewing is what tends to cause us to be more conservative and say, if you don't want any surprises, be in the primary program. But if you can handle the surprises, and that's really the question, is can you handle the surprises of the bad year from you still have to pay for it, compared to, the alternative, of course, is if you have a good year, you're in great shape because you have not spent that premium and you haven't paid out those indemnity deposits. So,
Right.
But it's more about the severity of those layers than it is the frequency.
Okay, so it's mainly then, the primary program, the X number of dollars you're going to be spending each year, whereas with retention, it can fluctuate depending on the claims, correct? Okay, one other thing. If we went with either program, and as Carly asked and you reaffirmed that a city can change from the primary program to the retentive program, or vice versa, what happens if, say, we go primary program and the sky falls in and we end up with millions and millions of losses in one particular year? Do you cancel us? Do you increase our primary program annual contribution, or do you push us off into a retention program so that we absorb more of the cost?
Well, for the first 3 or 4 years, you will pretty much pay the same rate for your coverage, irrespective of which program you're in, because we're comparing your cost quote now. We don't even know what 2021 looks like. By the time we are quoting 21, 22, we're still not done with 2021. By the time we're quoting 22, 23, 2021 is still too green to use. So it's about 3 or 4 years before you even see any significant change to your costs, except for variations based on your exposure. If you have, like you were saying, if there's a bunch of people that get hired or laid off, that will affect your exposure, and so that will affect how much you pay. If that happens, 4 years from now, and it's vastly different than what we've been underwriting, we would have some conversations. We would not be inclined to kick you out. We might try to find what would have been the most cost-effective place for you to be. Would it have been the primary program? Would it have been the retention program? And which retention program? And we also have 500,000 and 750,000. But that's a really big risk that you're putting yourself at from one year to the next. And there's not as much discount associated with those higher ends. So really, we only look down at the 250 level.
I have one final question, and as I told our city engineer earlier, you have to take out your crystal ball for this one. If you were the city of Hemet, which program would you choose based on the information you have?
That's not a crystal ball question. That's really it's a finance question to some degree, and how able is the city to respond if there's a bad year? It's easy to respond to a good year, but how able is the city able to respond to a bad year? If you have a number of public safety employees that have some sort of claims in the next year, and those are all retained losses, that's going to be in your account, your problem, if you will, as opposed to the primary program. For me, I would recommend the primary program, just from the perspective of it is one of the things about risk management is you want to have a known outcome. This, you know the outcome. It's $2 million. If that helps you sleep better, that's part of it. On the other hand, it's a big dollar difference between the two. Are you going to be better or worse than your last 5-year average of losses? If you're worse than your last 5 years, you save a lot in premium, but you end up paying you back in retained losses. So for us, typically, we are more inclined toward the certainty rather than the uncertainty, the certainty of the primary program.
Okay, thank you very much.
Thank you.
Bonnie?
I'd like to ask our city manager what his recommendation is.
Well, it goes back, I think, and I think the council will understand this analogy. When it comes to legal and city attorney expenses, what really drives that is your lawsuits that come up. And so basically the way that the agreement is set up is there is the cap that is provided for the SIR when it comes to legal expenses. So even though there was a big dollar amount associated with the Tucson case, the city had to deal with the influx of additional legal expenses that at some point we're in the middle of getting reimbursed. However, it comes down to that same scenario, just with workers' compensation. So how comfortable is the council in having the situation of having a number of workers' compensation claims that may happen in any given year, even though the historical context may provide a different picture? The same thing when it comes to the legal side. How comfortable if there was a cap?
I've lost Chris.
Can you hear me? Can you hear me, John? No, it's on. Okay. So, can you hear me, John?
Yes, thank you.
Okay, so if we were to take that same scenario and look at it for the, oh, this died. Same context for legal, let's say that there was the scenario where at any given time, the city would only be out of pocket for $1 million for legal expenses. Would the city take that on, knowing that maybe one year may have additional lawsuits than in another? That's really what it comes down to. So what's the comfort level of speculating and saying we may have a lot of workers' comp cases in the next year, even though I may not have the exact dollar amount of what that might be? What's the comfort level of the council? On the flip side, we know there's a certain level of comfort in knowing what the dollar amount is with a known, let's say, $2 million figure. We know that that's going to be the cost, we can budget for it, and we can deal with it on the very front side. The other side becomes more of this kind of intangible, best guess, best speculation on what we expect it to be in the upcoming year. It's a little bit of a gamble, obviously. And so it really comes down to the council's collective comfort level with saying we think that there may not be a lot of workers' compensation claims this year, or we know that maybe the trend is indicative of something creeping up moving forward. It's just our best, the council's comfort level with dealing with that scenario. I know that the council was particularly unhappy with the number of lawsuits and the high legal costs associated with that moving forward. So I can see both sides of the council's, the pros and the cons associated with that. The best way to liken it, I think, is with the legal side, which we've grappled with publicly here.
Oh, and I should have prefaced that question with, first of all, thanking Councilmember Meyer for doing the spreadsheet and the time she spent doing that and giving us something to look at. So, as you're figuring out our budget and see our budget scenario for the next few years, you are more comfortable with what option?
When we talk about the budget, I'm more comfortable with having a dollar amount that I can plug in and say that's what it's going to be. In the alternative situation, it could be higher, it could be lower. That's the risk that we're taking when we do that. And so for me, I would hate to come back to council and say, council, guess what? Higher number of claims moving forward, and now we have to identify a funding source for these additional items moving forward. I know the discomfort that the council has to grapple with.
Mm-hmm.
On the front side, I have a dollar amount. I know that it's not going to exceed that. But then on the alternative, there may be a scenario where we don't get to that point, and so there's money that's essentially left on the table, if you will. From my perspective, I would love to say, I'm going to project out and we're not going to have a high number of claims, and so I'm comfortable with that. But it really comes down to, if it comes in higher, you know that it's going to have to be made up somewhere. And
Yeah.
that's the challenge. Now, the council could explore, I think Councilmember Meyer brings up a good point. If we're able to essentially capitalize on some of the things that JPIA has to offer, and we're able to continue that downward trend that we're seeing, then I think it makes sense to maybe explore something a year down the road, maybe two, and really see what that opportunity is moving forward. I think that's really the value and the opportunity that Councilmember Meyer really identified is, if we're able to institute a number of things with the addition of the JPIA, what's our ability to continue that trend and really make a change moving forward?
And I want to point out something, Russ, on this, if I may.
Sure.
Oops. On the spreadsheet that I gave you, if you look at the year 2016-17, that was a very high loss. That year was a very high loss. I think it was the highest one. So if we have a year that is high and we picked the $250,000 plan, you can scroll over and we would, with that high of a loss, and you have, if we would have paid the $2 million, then we would have nothing on top of it. If we pick the 250 plan, then we are going to pay like $520,000. That's what our difference would be. And we have that year, and then if you go up 14-15, we would pay an additional $14,000. And keep in mind that obviously these rates would be lower back in the day, like John said, but we're just using this as our numbers for today. So another high year was the very top one, 10-11. We would have to come up with a $250,000. And coming up with $250,000 when we could save $500 each year, it's just kind of, that's why I did the spreadsheet for you, because you can't sit here and do all that. And I have another question for John. Do we have the aggregate stop loss available? Like an additional plan that would guarantee us that it would almost like double insuring? Not having a...
We do not have a stop loss on the excess programs. We retain, within the pool, all the losses that are pooled losses. And we don't have a program that provides an aggregate stop loss for your retained losses. Within the primary program, that's, again, not a concern. But
right.
In the access program, we do not have something. We could work with Alliant to try to find something, or one of our other broker, but at this present time, we do not have anything like that.
So we would have to get that from a different broker if we were to do something like that. Like if we were fearful of...
Yeah, I mean, we could help you. We could help arrange that through Alliant or our other broker that we work with for our workers' comp. It might be available. It's
right. I know they're common.
Bit of challenging.
Mm-hmm.
Yeah.
So our last 2 years.
I would have.
Yes.
I would add one thing that's important to note. The timing, the cash flow timing, would be different, obviously. $2 million this year, which basically is your expected losses and your, paying for the reserves, paying for the claims administration, all that sort of stuff, in lieu of perhaps paying less over the short term, but continuing to pay these claims for a long time. So like the example you were showing earlier on the page that you received this morning, there are some very old claims, and a little bit is being paid on those old claims, even though, so in a pay-as-you-go basis, you're going to continue to pay for those retained losses until they're ultimately closed. So there is a little bit of difference in time, which means you don't have to pay it all up front, but you will continue to pay it for a long time. But again, what's your question?
Well, our problem here is that we're cutting public safety in this town. So if we're going to cut public safety, then we've got to cut everywhere. We can't talk out of both sides of our mouth here. So that's our problem.
Understood.
Mike, did you have questions, comments?
I would just say that if we were to go with with the 150 or the 200,000 plan, it just goes that would be even more important that we implement a risk management program that would make sure that our employees are doing the right thing, they're not taking unnecessary risks while on work, and that they're doing their job safely. Because that's the only thing that's going to help reduce these claims.
And look at the last 2 years. I mean, it is 10 months ago. The most recent year is 10 months ago. But they have come down considerably. And obviously it goes up and down because you get one accident, right, and takes you through the roof.
Well, certainly this does require an awful lot of crystal ball stuff. I really appreciate Carly going to the trouble to create this spreadsheet, because essentially what she's handed us is a retroactive crystal ball that shows us what our history has been, and it shows some hypotheticals that, you know, kind of help guide us in our direction to staff. I totally agree with what Michael just said, that on the front end, a proactive risk management program and instilling a work ethic in all of our workforce to get their buy-in to how they can help the city financially by how they perform their duties is critical to trying to keep control over these things and keep the costs down. Then there's always the X factor that things just happen. Accidents do happen, and people can get injured. That's a cost of doing business. So I guess for me, taking a conservative approach initially, knowing full well that after we get those first 3 years, we have the option of making some adjustments. So that's kind of the beauty of being involved with the JPIA is that flexibility. So I guess that's kind of where I am, is leaning towards taking the more conservative recommendation initially, and then watching closely, doing the proactive risk management program, and then see where we are as time goes on.
And you didn't have to lose a fire engine.
You gotta add that.
Got to speak the truth. It's $1 million we're talking about right here. We're talking about $1 million, and you're not willing to take that risk. I did the math for you, and you still can't even read it?
Any other comments? What's your preference? I'm not married to any of this, because there's so much that could happen, might happen, historically has happened, hasn't happened. There's just an awful lot of information that it's an educated guess.
Well, I'd like to see us go a more conservative approach too. I don't know if we have the luxury of thinking what we may have otherwise. It'd be good to know where we end up after a year or so, and decide. And if we need to make a different decision, we have that opportunity to do that. But I don't really know what you're proposing, because I just thought what the mayor just said kind of went along with what you were saying all along, and yet you took offense to it. So I don't know.
He wants to pay $2 million. That's what he said. So if you're good with that too, then we'll know. I'm not okay with it. I think that we could actually get away with a 250 plan.
Is that what you said?
No, that's
no,
not.
I didn't think
no,
that's what you
not
said.
what I was
He said he
saying.
wants to take the conservative approach. The most conservative plan on here is $2 million.
No, I think it was the cost of the more conservative. I'm not going to speak for you.
Yeah, well, that's
Sorry.
what I was getting.
The 250,000. Is that what you were?
Yeah, I was
That's
talking
what I
about
thought
the
you
more
meant.
conservative cost approach.
Yeah, that's what I thought you
That's
meant.
what I was being.
That's how I took it.
That's not how I took it. that great?
Okay.
John, are you on there?
I am.
Okay. What,
Yeah.
there's a sheet that we got that says total projected workers' compensation costs, external and internal. There's a subtotal in the first column for the primary of $1,997,900, which remains constant for its external costs and down to the bottom. But all of the retention adds costs for internal costs and then another consolidated total. If we went with the 250 retention, what would our total premium be?
If you went with a $250,000 retention, your premium paid to us is $817,900, and then you would fund a trust account, not the whole $1 million, but you would have a contribution to a trust account that would need to be maintained for payment of claims within your retained layer. So that's really the question. What's in the internal cost piece? That's the question mark of the crystal ball. If you have a good year, then you won't spend $1,024,000 plus claims development. If you have a bad year, you may spend more than that. But I agree with the comments. Two parts. First, as we start implementing some risk management stuff with the city staff, I would expect to see a greater risk management awareness among your staff. And then to Councilmember Percival's point, when you have skin in the game, you tend to be more in touch with it. And so one way that many of our members do this with their employees is through cost allocation within departments. And I'm not sure if your city does that, but you can have the departments that have the losses pay more of those losses rather than it coming out of just a general budgetary fund. So that might be a place where we can do some work as well. So truly, I think the $250,000 option is as good an option as the primary program, and certainly you will pay less money on July 1 than you would pay in the primary program. It's just how much will you pay down the road or not pay. So.
Okay, but you mentioned the trust fund. Do we have to fund that immediately?
You would need to fund, and I'm sorry, I don't know the amount you would need to fund, but it is based on your expected losses. So there would be an amount that would need to be funded come July 1. Yes, I would guess, based on this, that it's probably going to be about $250,000 if I was to pick a number, but don't quote me on that. But it is based on the expected cash coming out of that account to pay for losses.
Okay, and if we have some serious losses in the next year or two, that amount in the trust fund will increase or remain the same?
Yes.
It will increase?
It will increase.
Okay.
Yeah, you will need to, because you will be paying those losses from that trust fund, you will need to make sure that there's enough money in that trust fund to pay them.
And so the trust fund will be our money still, and it will be comparable to the reserve account that we talked about earlier. Instead of paying the insurance agency the money and then it's sitting in their reserve, since it's self-insured, that we are putting it in our account for these payouts. Is that a simple way to say it?
An account that is owned by you, but the checks are written by the third-party administrator, yes. It's your money.
It'll be our money.
Okay, trust fund is city's money.
Correct.
Those funds are.
Yeah.
I'm not sure on an accounting standpoint if it stays on your books or on our books, but it is the city's money. Probably on your books.
Thank you.
Any more questions? Somebody want to take a shot at a motion?
Motion card. I move that we
take the $250,000 retention policy out with those workers' comp with the JPIA.
Second.
Okay, we have a motion and a second that we do the 250,000 retention program, correct? Roll call vote, please.
Councilmember Meyer? Yes. Councilmember Percival? Yes. Councilmember Wright? Yes. Mayor Pro Tem Krupa?
Yes.
Mayor Brown?
Yes, that passes unanimously. Thank you very much, Pat. Erica, thank you, John, for joining us.
Thank you.
Thank you.
Carly, thank you for your work on the spreadsheet. Sorry you misunderstood what I was saying. Breakdown in communication. It happens. Okay, that concludes item 15B, so we're on to item 16, council and staff reports. Councilmember Meyer.
I don't have anything, but I'm excited to get back into the swing of things if we can start having meetings.
Councilmember Percival.
I don't have anything.
I don't have anything either. My meetings are tomorrow and,
Come on, I'm the only one?
well, big surprise. Not surprised. Okay. Well, none of the first ones have done anything. League of California Cities, the policy committees are meeting June 4th and 5th, and they will be electronic or video conferencing, which is good because we were supposed to be going to South San Francisco. So that is coming up. The Ramona Bowl Board, they are actively doing construction improvements up there. RCTC is actually looking at a live meeting for the meeting in June, which I think it's the second Wednesday of the month, and it will probably be a hybrid with some people in person at the county building and some video conferencing so we can all maintain our social distancing. I participated in the Waste Management Task Force meeting this last week by Zoom, and Charles Russell, our refuse manager, did an excellent job of chairing the meeting, and they were talking mainly with one of the, can't remember the assembly bill, that deals with recycled food, and instead of going into anaerobic digesters, can it be used in any way? And when you say recycled, it sounds like it's garbage anyway, but it's not. It's unused produce and things like that. Can it go to homeless people? Can it go to people who are in need of food instead of being dumped either in landfills or in an anaerobic digester? I think I got that right. If I didn't, Charles, if you're listening, you can correct me. RCTC is this week. SCAG is also holding its annual conference on June 4th, which is a Thursday, and instead of 2.5 days out in the hot desert, it will be video conferencing on that one too. So there's a lot of video conferencing going along. And I was going to report on this flyer. Did everybody get that? And Chris, are you going to be talking about this Cal EPA? It is from Winefield and Associates. Contact Cal EPA by June 1st, 2020 to stop vapor intrusion guidance document that will thwart property development in your city. And it has to do with water quality. And vapor intrusion apparently into your water things, and it's we just need to send an action letter, apparently. It was in my box, and I had actually seen an email on it today, and I'm going, well, thanks for the early notice. Yeah.
But anyway, I don't know if we have to vote on this, to send a letter to Cal EPA saying stop this immediately because of COVID. We don't have time to respond.
I would recommend that we add it to the agenda if the council would like to do that, and then I could just bring the letter for ratification at the next council meeting.
Okay.
I would make, do I have to make an emergency addition first?
No, when we go to the future agenda items.
Okay.
We can do it then.
Got it. Okay, that's all I have. See, it wasn't that bad, Bonnie.
Okay.
No, we love to listen to all the things you're doing.
Take the tongue out of your cheek when you say that. Like everybody else, I've been participating in Zoom meetings and getting more and more comfortable with a Zoom meeting. I don't know, it'll be interesting to see if that carries forward, because it's, there's some, I like meeting in person too, but there's certainly some cost savings associated with that, and time savings, because you can meet right at your office instead of having to drive 45 minutes.
When you work, too.
So there is a benefit to that. So they may be a part of our future. I did have a couple of challenges with the some overlapping Zoom meetings between the RCHC board meeting and the District 3 Economic Task Force. So I jumped in and out of both of those to make sure that they had quorum for those meetings. But the main emphasis on part of the District 3 Task Force meeting that Supervisor Washington has organized is encouraging our constituents to get COVID tested, whether you have symptoms or not, because it's a threshold that's part of our ability to move forward into opening up our community and our businesses, because it's all based on the positivity ratio. And so the more people that get tested, that has a favorable impact on our positivity ratio, which the governor has set at 8%. And I think, at least the last time I looked today, Riverside County was 6.7%. So the Supervisor Washington was encouraging people to go get tested if they can possibly do so. I know Mayor Pro Tem Krupa went Saturday and was tested. I went today. My wife and I got tested, and we went to the Paris Fairgrounds. Now, she got the throat swab on Saturday, so that's why I specifically bypassed going to San Jacinto, which was closer. I said, I want to do the throat swab because the nasal didn't look as pleasant. So I got out there and they did the nasal swab. So, and I asked them what the difference was. I said it's based on what kits they give us when we come out each day. But they are open 9 to 2, Tuesday through Saturday, and that's and the county has opened up some more. I believe that the state operated are still requiring people to have symptoms or believe they have symptoms, whereas all of the county test sites are open to anybody that wants to be tested, symptoms or no cost involved. So that's about all that I have to share with you. So ad hoc committee reports, SR 74.
Moving ahead. It's a mess down.
I did have a question, but I see our police chief has left. Go ahead.
So I was coming westbound on Florida Avenue today, and Squad 5 was Code 3 coming up from behind, and both number 1 and 2 lanes were occupied, and so was the turn pocket, and so they got stuck behind until the person in the turn pocket finally moved. They couldn't go around.
That's right.
Where if the median was not raised curve, they could have just gone through the turn.
Yeah.
Went around. Easy peasy.
So, just a question for our police chief. Were you aware of did we have any major collision or anything on Florida, somewhere between like Warren and California?
Yeah, west of the aqueduct, and that belongs to CHP will handle those. So everything west of the aqueduct is handled by CHP.
Was there
Yeah, I think it occurred sometime around 1,705 cameras.
Yeah, that would explain it then, because when I tried to come here, I had to take the Magellan route to try to get here, because everybody was turning off of Florida, going to California. So Devonshire was completely jammed up both directions, east and west, so they must have been diverting at Warren in California.
Yeah, that was the last I heard.
Okay.
I don't know the extent of the injuries or...
Okay, well, that's good to know that it wasn't just their construction that was causing all that, because that's a big enough mess as it is. Okay, ad hoc committee, nothing new to report on council protocols. And city manager.
I do not have any updates at this time, Mayor. Thank you.
Okay, thank you. Future agenda items. Linda?
Yes. Future agenda item would be to send a letter to Cal EPA regarding the vapor intrusion guidance that is coming out. That on February 14th, 2020, the vapor intrusion guidance was issued, and it's worse than previously imagined. Cal EPA guidelines give no consideration to impacts on real estate development projects and the effects on blighted communities, nor does it use scientifically defensible criteria. What they are suggesting is that we should tell Cal EPA that they should cease implementation of the vapor intrusion guidance document until California-specific data are developed and after municipalities have effectively addressed the COVID-19 priorities. And there's an email address to the Department of Water Quality, vapor intrusion at waterboards.ca.gov. And they go on to list why this is not good, especially for us, and that it is based on empirical data from only 6 locations throughout the state. But Cal EPA has begun enforcing new standards, and contaminated sites can no longer be cleaned up to make way for housing or commercial developments. So it sounds like it's bad news all the way around, and I would make a motion that city manager write a letter based on this. Second.
Okay, we have a motion and a second to add the item to future agenda items to do that letter. We have a roll call vote, please.
Councilmember Meyer?
Yes.
Councilmember Percival?
Yes.
Councilmember Wright?
Yes.
Mayor Pro Tem Krupa?
Yes.
Mayor Brown?
Yes, that passes unanimously. Bonnie, you said you had something that you...
Yeah, it's come to my attention that the bank that we use, Citibank, has left the city, and you have to go to Banning. So I would like, we've been trying to go through that, we've been trying to do this for a number of years. I think we need to look at alternative banks here in town, and hopefully we'll take a good look at Bank of Hemet, our local bank, and see if we can't change our banking from our current bank to another that happens to be in the city. And I understand that years ago when we looked into Bank of Hemet, they weren't capable of doing the payroll and other automatic transfers and things like that. But that is no longer the case. So I'd like us to look into moving our accounts elsewhere out of Citibank. Huh? Second. But you have to go to Banning to do any business.
Second.
Okay. We have a motion by Bonnie, second by Carly. Roll call vote, please.
Councilmember Meyer?
Yes.
Councilmember Percival?
Yes.
Councilmember Wright?
Yes.
Mayor Pro Tem Krupa?
Yes.
Mayor Brown?
Yes. Motion passes unanimously. There being no further business, this meeting is adjourned to the next city council meeting, June 9th. And thank you for joining us electronically and telephonically. And Godspeed to our astronauts as they attempt to launch tomorrow in the SpaceX. We're adjourned.
Hey, wasn't it supposed to be